Welcome to the Winner's Playbook with Steve and Josh. Disclaimer: the information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you wish to book a free 15-minute call to discuss your personal situation.
Welcome back to the Winner's Playbook. I'm not Josh Lee or Steve Sloan. I'm Billy Norman, another advisor at Link Wealth Group, and I'm hijacking the podcast this week. Now, you might have seen me on TikTok or LinkedIn before talking about all things finance related, and you'll probably start to see me a little bit more on this podcast. Today is not about me. I'm actually here with a very special guest, Belinda Raso. Belinda is a fellow of the Institute of Public Accountants and a registered tax agent. Belinda started in the accounting industry more than 20 years ago, initially founding a bookkeeping and small business advisory firm in 2003. In 2012, whilst running this firm, Belinda started contracting as a tax consultant to other accounting firms. This spurred on her passion to have her own business, which she did when she founded Tax Invest Accounting in 2015. Belinda specialises in individual and investor tax, startups, entrepreneurs, and SMEs. Now, Belinda's passion is to educate the Australian community on everything tax and small business. And she utilises her social media platforms to do that. Tax Invest Accounting has more than 100,000 followers across 3 platforms: TikTok, Instagram, and Facebook. Belinda, welcome to the Winner's Playbook. Thanks for joining me.
Thank you.
All right, so let's dive into it. Now, I've got some questions prepared, of course, and some of them are relating to like personal tax and individual tax. And I've got a couple of questions around business owners as well. But before we get into that, I'm keen to hear your story about how you started your business.
Okay, so I'm not a traditional, it wasn't a traditional path for an accountant. I actually started as a bookkeeper and a small business advisor first. My background, I was actually a manager for Coles. So that started from when I was 19. Wow. And it was actually really good training. I had such a great ground in working with Coles, and I stayed there until I was about 25, 26. And then I did a couple of management courses on top of that and decided to get into bookkeeping and small business accounting. And I pretty much just started that in 2003 with my best friend. And then I felt it wasn't enough. I had so many clients saying to me, you know, I want more advice. I want you to be my accountant. And my love for tax, actually, it stayed on par with my love for small business. So I decided that's it. I want to do some more study and become a tax agent as well. And then in the process of getting my tax agent license and all my studying, I was doing consulting work with different accounting firms. And it actually opened my own practice in 2015. So very busy for many, many years.
Amazing. Yeah, it's interesting you say that about Coles, because one of my first jobs was in McDonald's. And yeah, I highly recommend starting out in that sort of role, just in retail or something like that, because yeah, it gives you a really good like grounding for just like hard work and dealing with managers and really structured environment.
Absolutely. Yeah. It was just such great grounding. And I started off as a manager at 19, which is very, very young. But I remember one of my senior managers said to me, because I did start out as a variety manager. So back in the day, this was many, many moons ago, we used to sell clothing and that at Coles. And that was my first department manager job. And when I moved up and went into grocery and then store management, I remember he said to me, it doesn't matter what you sell, whether it's apples or clothing, management skills are the same. So take that with you. And I did. And to this very day, everything I learnt from Coles, I actually use with small businesses now. And it's made such a huge difference to so many clients. So it's a really, really good grounding. So if anyone has kids, starting off with those organisations actually really teaches them great skills that is going to help them in their future.
Yeah, awesome. And so your business now, Tax Invest Accounting. So you started that almost 10 years ago now. Is that right?
Yes, yep. So that was actually 2015, but we actually continued our first business up until that day, and that started in 2003. So I've been a small business owner now for 21 years, and I laugh and say I haven't had any sick pay or annual leave for 21 years, but I tell you what, it's worth it. And all those mistakes I've made along the way, I use that and help people to try and avoid those same mistakes.
Yeah, amazing. And how has it changed? How's the nature of your business changed today compared to, say, early days of, like 2016, 2017? How has it evolved since then?
Honestly, our business has evolved and it's changed constantly. So even when we were doing bookkeeping and small business management, Tax Practitioners Board brought in the BAS agent license. So that changed everything back in 2009. And then pretty much every year we wait for budget to see what's going to happen every single year, what's changing. It's just an ever changing environment, and I feel like an absolute tax nerd. My friends laugh at me. I'm constantly researching because honestly, everything changes and we just need to be on top of it.
That's it. So on that note, what changes can we expect now? Like this podcast is being recorded around the end of a financial year. So what's changing with the latest budget and ticking over into 2024-25? What are the main things people need to know about?
Well, a massive change that we've got that's been advertised everywhere is the stage 3 tax cuts. Now, this is a traditional tax cut, and we haven't seen anything like that for many, many years, let alone an overhaul on our income tax system. So whereas most people have been used to the income tax offset, we've been given that additional money every single year. Most Aussies were shocked to find that they ended up with a tax debt last year. And unfortunately, if people haven't addressed that from last year, they're going to be in the same boat because these stage 3 tax cuts will not change any of this. Now, these don't start until July 1. So our tax return this year is going to be exactly the same as last year. And honestly, it's not going to change moving forward. We're not going to have that tax offset ever again. Whilst these stage 3 tax cuts are great and they're going to mean more money in your pocket, you're going to see them in your pocket every single time you get paid. So that end of year bonus that we've been used to for so long, most people actually took their tax returns for granted. They were getting that $1,000, that $1,500 without even trying or thinking. Those days are gone. We need to start putting the effort into researching our deductions, knowing what we can and can't claim, because a refund is not guaranteed for anyone.
Yeah, interesting point. I've heard that a lot as well. People just saying, well, how come last year I got $2,000 and then this year I didn't? Like, what's happened? So yeah, it's important to know. And so on that, if we look back through like COVID and lockdowns and stuff, which was obviously a lot more prevalent here in Melbourne, but people started to understand some of the expenses they could claim with like working from home and work-related expenses. But it seems now like the tax office is cracking down a bit on that. So
absolutely.
What are the big things we can claim, generally speaking, for workers, and what should we be wary of, or are there any like big common misconceptions around it?
Okay, so our work from home deductions have changed, and they changed last year. And when they actually announced it, it was first came out as a draft in 2022, November 2022. And I remember reading it again, just doing research and thinking, there's no way that they could possibly be bringing this in. They couldn't bring this in mid-year. Well, they did. They brought it in March last year. So basically, they backdated the changes. So the shortcut method that we knew of 80 cents an hour that covered everything, well, that went. We now go back to the actual cost method and the fixed rate method. Last year, they were quite lenient with this. The ATO was like, oh, we've brought it in midway through the year. How much are we going to police it? And honestly, they really didn't. But this year, all bets are off. So if you're claiming that fixed rate method of 67 cents per hour, you must have, and I cannot stress this enough, you must have a record every single hour that you work from home. So if you just do a copy and paste from last year, or if you look at doing what most people have done is say 38 hours times by 48 and get that amount, the ATO will pull you up because that's exactly what they're looking for. So you need to remove the hours that you had as sick leave, you need to remove your annual leave and also public holidays. So it has to specifically be those hours that you're working from home. Now, with that working from home fixed rate method, you don't need to have an office set up. So that's the one good thing. You don't need to even have a desk or a chair. You can claim that. But what you do need to have is a record of the expenses that you've had. So one bill of the following: internet, mobile, stationery, and electricity. Now, if none of these are in your name, that's okay. So say if you're renting and it's in your flatmate's name, you'll just need to have like proof that you actually pay towards this. So this could be a transfer with your rent or an agreement that you have with your landlord, but you need to show that you've actually incurred these additional costs. So say if your employer's paying for your mobile, at least have the internet and electricity and one piece of stationery. So even if you go out and buy a diary, yeah, just go out and buy a pen before the end of the financial year. This is how nitpicky they really are, because basically they don't want to be paying this work from home rate. Now, your alternative to this is doing the actual cost method, which has always been around. And with our clients, we always calculate both to see which one's going to be more advantageous. But with that actual cost method, what you do need to know is that you need to have a desk and chair set up. So it could be in part of a room. It doesn't have to be a separate room. But what we need to work out is how many hours you're working from home so we can apportion what the electricity would be for that size of that room if it is a shared room. So they're the important things.
But so make sure you set up your desk in the biggest room in the house, is what you're saying.
And regardless of which method you use, most people keep forgetting, they keep thinking about that shortcut method from the past, from COVID. So there's so many things that you can still claim with this fixed rate method. So you can claim all of your computer software, all of your computer hardware, no stationery, no printing and paper, but everything else. So think outside the box. You've got all of your furniture, you've got your desk, you've got your chair, you've got your chair mat, you've got a bookshelf, you've got a desk lamp, you've got all of your subscriptions that you have on your computer. So think Microsoft Office, think Canva, all of it. People just need to start thinking a little bit more and not just rushing into their tax return and assuming I'm getting the money, because you're not going to get the money.
Yeah. All right. So, yeah. Okay. So you effectively, like, you need to be mindful through the year, right? Whenever you spend money. And on that, this is something that I've struggled with is, tracking your spending and keeping receipts and things like that. Are there any really good apps or software or anything that is good for this stuff, for tracking receipts and spending throughout the year? Like, so, this is, and not for business owners, let's say just for your personal tax.
There is HubDoc, but there is a fee for that, but you could claim that fee on your tax. One simple thing that most employees could do is just take a photo of their receipt and save it in a folder on their server, on their cloud, tax 2025, and it's all ready for next year. A lot of people think that they have to have that physical copy, but the ATO accepts digital copies. Take that photo, even if it's a Woolies photo and you've just purchased some items, like not all of them are for work, highlight it, take a photo and save it. That is the key thing. Now, if you have lost your receipts, you can recreate a tax record with your bank statement, but you need more than just the bank statement. Basically, the ATO's after 4 pieces of information. They want to know where you purchased it, when, how much you spent, and what it was for. Now, a bank statement is going to give you 3 out of the 4. So what you need to do is print off that bank statement and write down the details of what it was and what it was for. If you have the item, if you still have the item, which is even better, take a photo of it or the packaging. And then you can actually satisfy that rule. A lot of people don't want to put the extra effort in, but think about it. You can actually get what, 34.5%, 34.5% back for every $100 you spend. It is worth the effort. We would make the effort to keep receipts if we knew that there was something faulty with a product. We need to get that mindset again. All Aussies need to get that mindset that refunds are not automatic. We have to start taking the steps every single time we purchase something for work to keep it. That is money in our pocket that we're losing.
Yeah, amazing. So, I mean, it sounds like really just, taking photos and storing them in a folder and then dealing with it at the end of the year and sorting through it all.
I just say to my clients, would you throw $34.50 away for every $100 you spend? And that's literally what we're doing, because that is your cash refund. That is how much you're throwing away by throwing away a receipt. So it's crazy to think that we're doing this every time.
Yeah. Okay, that's really helpful. And so we've got lots of clients with investment properties. What's the story there? Because I keep seeing, news and things from the ATO saying like people are over-claiming or double-claiming, but I'm sure on the other side there's definitely people who aren't claiming certain items as well. So what are the main things you're seeing there that people are going wrong with claims on rental properties?
I cannot stress enough how much they're actually going after investors this year. The ATO have stated that 9 out of 10 investors are getting their tax returns wrong, even when they're lodged with a tax agent. And they're actually putting the blame squarely on investors, because as tax agents, we can only complete the work that with what you've provided us. So we can't wring your neck and say, give me everything. But we've got to ensure that across the board, all accountants are actually asking the correct questions. And these are the things that we need to know. Number one, they're looking for undeclared income. So this is the first year, as part of the data matching protocol that the ATO has got, they've expanded this to the share economy. So since July 1 last year, short-term providers, accommodation providers like Stays and Airbnb are actually reporting directly to the ATO. They've already received 6 months worth of information as at 31st of December, and they will receive the rest of the information by 31st of August for the second half of the year. Now, so they've said in the past, Airbnb and Stays have told investors since 2019, look, we're going to let the ATO know, but it's the first year that they're actually stating, this is the person, this is how much they've received. So if you're an investor, or even if you're renting out part of your home and you're going through Airbnb and Stays, the ATO knows this. So you need to actually be getting on the front foot and declaring all of this income. That's the first thing that they're doing. This is actually going to be extended from 1st of July 2024 to long-term accommodation providers, so all rental property managers. So that's one element that they're looking at. The second element is ensuring that the properties are actually available for rent. So with the rental crisis, the way it is in the country, the ATO is trying to play the good guy and say, okay, all investors are bad. And that's not the case. We all know that's not the case. Investors are providing accommodation. So we shouldn't have that whole playing this good guy, bad guy game. But the ATO is saying, okay, we're going to, make ourselves look better. We're going to come after you. So one thing that they are doing, and this is good, they need to be able to, investors have to prove that their property is actually available for rent. The way that you do this is by either showing a contract with the property manager or providing documentation of advertising, paid advertising, because the ATO isn't going to allow you to say, here's all my deductions and I've got $1,000 worth of rent. They will pull that up for an audit immediately. The second key area that they're going after is loans. I've been through a couple of audits with the ATO. So what the key things that they're looking for is that the investment loan hasn't changed. The amount hasn't changed unless the property has had, like you've done a reno and you've borrowed extra money. So if you've got a redraw facility on an investment property and you're taking money out and putting it back in, you can't be doing this. You do not want to have a redraw on an investment property at all. Once that money goes out, it's out, and the ATO is not going to allow you to put that back in. So if you have a property and you've got an initial loan for say $800,000, they will track back for the past 20 years of how that loan has looked and how the amount is, because that loan should be going down. Even if you're just getting charged interest, it will always go down. So that is one key area that they're looking at. They actually match up the interest to the cent with your financial provider. And then the third key area that they're looking at is repairs and maintenance. And this is a big one. The ATO states that there's initial repairs, which need to be claimed over 40 years. So you purchase a property, the property manager says, we need all of this done before you can start renting it out. That's known as initial repairs. It can be claimed, but it has to be done over 40 years.
Is that repairs even like minor things? Sorry to interrupt. Is that even minor things?
Sorry, not under $300 is fine. That's no problem.
Anything over $300, if it's when you first buy it, you can't just claim it in that year. It has to be spread out.
Yeah.
Wow. Okay.
Then we've got repairs and maintenance, and then we've got improvements. So what the ATO sees as a repair and a maintenance is when there's damage to a property from a tenant. So say the tenant damages the wall, you go and paint the wall. That's fine. You can actually claim that in that financial year. But most owners will say, well, if I'm painting one bedroom wall, I'm going to paint the rest of the house. So that's seen as an improvement. So that painting then has to be claimed over a number of years because you're changing the property. You're improving the property. You're not just repairing that damage. And too many times investors are actually spending a lot of money, especially before June 30. They're told by property managers, spend it, pay us before June 30, you can claim it all. And cash flow is a huge issue for investors as well. So you need to ensure that you're speaking to your accountant first before you start making these decisions on what can be claimed immediately and what needs to be claimed over a number of years. Basically, if it's over $300, in most cases, it's going to be over a number of years. If you're replacing an asset like an air conditioner, a stove, anything like that, that'll be over its useful life, generally up to about 10 years. Just bear this in mind before you're making those decisions, because you're going to unfortunately get a rude shock when you go and lodge your tax return and you don't see that money coming straight back to you.
Interesting. Literally an hour before I jumped on this podcast, a client emailed me because they just bought an investment property and the property manager said, the shutters need replacing. Do you want us to do this before June 30?
Yep.
Just before I jumped on here.
Yeah.
So good to know.
Yes, and there's also borrowing costs as well. So people need to be aware that when they're purchasing a property, a lot of those costs as part of purchasing that property forms the cost base of your property when you go and sell it. It will help reduce your capital gains tax, but it's not going to be claimable on your tax return.
Yes.
As long as people are aware, with this information, the more information you have, you can make those important decisions when you are purchasing your property, maintaining your property.
That's it. And the thing about redraw with loans, am I right in thinking, because what some people do is buy a house, live in it, then they want to buy a bigger house and they'll rent out their former home, right? But if that home loan on their original home, if they've been redrawing and using it, using it like an ATM and putting money in and out and so on, they then rent out that property, does that mean that's going to cause issues, right, with claiming the interest expense going forward?
Absolutely. So what would happen in that situation is you would get a valuation, number one, on that property when you move out of it. But in most cases where it's been your PPR, you're going to have a lower loan. So your deductibility is going to be quite low. You can utilize that 6-year rule, and we may need to discuss this on another time.
Separate topic,
separate topic. But I do say to a lot of people to have that discussion with your accountant first to see whether you're going to be better off actually selling that property that was your main residence before and then just purchasing something that's an investment property. So then you can have that full loan. So if you're going to purchase something for $1 million and be able to have, say, a $900,000 loan, it's going to be very different to having a $200,000 loan on your former property, unless you've got a personal attachment to it. But when it comes to investing and making money, we've got to leave emotions out of it. That may be the better decision that you make.
Yeah, spot on. We've been talking to clients a lot about that because people think, I'll upgrade the house. Awesome. Now I get to have an investment property. but
Yep.
it's not always. It's like you've got all of Australia to choose from. Was that first home, is that the best choice from an investment strategy perspective? Number one. Then number two, as you raise, it's not optimized for tax either.
Absolutely not. And literally, and then banks will say, and I've got clients that will say to me, but can't I just swap the loan amounts? Unfortunately, no. That's just not how it works.
No, and the ATO, there's a good chance they're gonna ping you on that, like they're gonna find out.
Absolutely, they know everything.
Oh, yeah, all right. Okay, that's awesome. A couple of questions just for business owners. This is a really common question. So you've got someone that they start a business. Usually they start out as a sole trader, right? So they don't set up an entity, a trust, a company. They just start operating in their own name. So everything's in their personal tax return. At what point should they be considering using a trust or a company to run that business through?
Okay, so there's a lot of factors in this. Now, firstly, we look at the industry that business is in. So if you're in an industry where you need that protection of that entity, so say in something like construction, even in consulting where you actually, like as an accountant, where you're giving advice, we would, if you're open to being sued, an entity is a lot better for asset protection. But when it comes to income tax reduction, an entity is not always going to be your best friend unless it just depends on the business. Let me break this down. The ATO have a big thing on personal services income, and personal services business is actually, they've got a draft ruling at the moment. So the ATO is going gung-ho at businesses that are actually an entity but are actually a personal services business. When you're a personal services business, you're basically selling your brain. So you could be consultant, you could be professional. There's no product to actually that you're selling it with. And in the eyes of the ATO, they see that as personal services income. So if you set up an entity for anything other than asset protection to try and reduce tax, they won't let you distribute that income, whether it's a trust or whether it's a company. In the case, say, I'll give you an example of an accounting firm. If it was just me, no other accountants in my firm, I was the only one earning income, I wouldn't even be able to have expenses as a normal business would, say a plumber would be able to have like admin staff and claim those expenses, because I'm the one, only one person is bringing all of that income in. So it's a personal services business. Regardless of what your entity structure is, you cannot then use tax minimisation methods. The ATO is looking so closely at this that they're using the ruling of anti-avoidance. So we're going to start hearing more about this in the next 6 to 12 months, because unfortunately there's been a lot of different advisors on social media, especially telling people, spooking, set up a company, set up a trust, distribute it to your wife, distribute it to anyone, and then you can hide your income. They're really clamping down on this. That's one aspect to think about. So when we do look at when is the right time for a business, it's going to be dependent, number one, on your industry and what you're looking for, whether it's asset protection and whether there is an opportunity for you to minimize tax legally in your business. Most people aren't aware of this though. They go and set up a company and they think, well, companies pay 25% flat tax. That has to stay, that profit has to stay in the business for you to be able to get that tax rate, that lower tax rate. So if you're drawing out money, you're basically, that's your wages. Whether you're physically saying to the ATO that it's your wages or not, directors' loans are treated as wages. So you can't just draw money out of the business and not be taxed as an individual. So it's the profit that stays in the business gets taxed at that lower tax rate. And then you use that to invest back in the business to expand the business, or you can even utilize that to then get investments in that business. You can do that, but you can't just draw the money out. And a lot of business owners get a rude shock when they say, why am I paying the individual tax rate when it should be 25%? So setting up a structure isn't always going to minimize your tax, the majority of times it's going to be a great asset protection wise.
Yeah. Okay. So it's really tax and it's asset protection are the two considerations, two big ones.
Yes.
So in some cases, if you're starting a business, you might start with a company from day one because you need that asset protection. And in other cases, it might be completely appropriate to be a sole trader for some time.
Absolutely. People fail to realise that over 60% of businesses in Australia are actually sole traders. You can have employees as a sole trader. You're not an employee if you're a sole trader because you are the business, but you can have employees. You can be registered for GST. You can be a legitimate business as a sole trader. Once your income starts getting over the 120,000 mark, that's usually where I have that discussion and say, okay, let's talk about the structure in your business, especially if it's a side hustle or if that person individually owns a lot of assets. It has to be on a case-by-case basis. If you've got an accountant that's saying to you, well, I just automatically do it at this point or I automatically do it from the start, we're not always, that's only benefiting the person that's setting up the structure. And in most cases, that's the accountant. I'm always honest with people and say, let's look at your specific situation. What are your assets? What are your goals for this business? What industry are you in? Will your clients, like if you're in the construction industry, a lot of times they won't deal with people that aren't either a trust or a company. It has to be done on a case-by-case basis. Yeah. And I personally ran, until I started the accounting business in 2015, I ran as the sole trader for 14 years, and legitimate business. There's nothing wrong with being a sole trader. I think sometimes we can look down on it, but absolutely nothing wrong.
Discriminated against.
Oh, absolutely.
Yeah. Okay. Great. That all makes sense. So it's really case by case. There's no hard rules there. Okay. Now, so a lot of your clients and a lot of the work you do is with business owners, startups, entrepreneurs, etc. Are there any common themes or things that you have identified over the years to understand why some people are successful in these businesses, and whether that's to do with the actual person and their attitude, or if there's some factor that's around like their accounting and their structures and so on, like looking at, say, P&L statements and things like that? Are there any sort of common themes you see?
Yep. The first thing that will lead to a successful business is every 6 months looking closely at your costing. If you don't look at your costing and you don't know how much it costs you to actually open your doors every single day, you may not be in business in 2 years. That's number one. Costs go up all the time. And when I say to a client, especially when I get a new client on board, I say to them, how much does it cost you to make that product or sell that product or open your doors? They never know. And that is the biggest problem. You need to know what your fixed costs are in your business. You need to know what your variable costs are. You need to know how much you should be selling your product for. And the only person that's going to know that is you. So it is so important that you have someone on your side, an advisor on your side that will listen to you, that will explain these things to you, but you cannot keep your head in the sand. You need to know these numbers. And the biggest mistake most people make, and they'll say it to me, I hear it all the time. Oh yeah, I'm making money because this is what I buy it for and I just put on 30% for tax. And I say to them, where's your profit? Where's your profit? No one ever adds that in. You need to add in 30% for your profit, because basically what you're telling me is that you're doing this business to break even. You're not compensating yourself. You've got money there for your staff, you've got money there for your expenses, but where's your profit? If you don't factor in that profit, you will not survive, because where is your money? That is the biggest mistake. And those business owners that are smart enough to think about their profit, they're the ones that succeed.
Awesome. Thanks a lot for your insights today, Belinda. Some really valuable stuff there. Now, where can our listeners find you?
Yep. So on all of our socials, it's at Tax Invest Accounting. And I know a lot of people say that their firm's different, but where we are different is everybody is important. It could be an investor, you could be a small business owner, you're all important. Our main aim is to educate the Australian community and have somewhere for people to go, oh, this is how we do it. Because too many times, so many firms are focused on the big companies. That's not who we are. We're out there for the mums and dads. We're out there for the little people. You may not even own a business. You may just have a little spark or a thought of a business. Give us a call. You're the exact type of person that we want to work with.
Amazing. Well, thanks, Belinda. Thanks for joining us on the Winners Playbook.
Absolute pleasure. Thank you so much.